Hi, my name is Matt DiGeronimo. I'm the Managing Director at Floyd Mergers and Acquisitions here in Honolulu, Hawaii. This is the part 3 of our series of videos about business valuations. In this short video, we're going to discuss one common misunderstanding regarding the valuation of your business. And that is, how does the value of your assets come into play when valuing your business? Okay, so let's use an example to make this simple. You run a business that does $500,000 a year in revenue, and after we do some calculations to determine your seller's discretionary earnings, which is essentially the cash flow to you, we derive it SDE, seller's discretionary earnings, of $100,000. And let's just say we further evaluate the different buyers that we believe would be in the market for your business and come up with a price of $300,000 for your business. It's not uncommon for us to have to answer the following question. Well, what about my 2 vehicles that I use? I think they're both worth about $50,000. Am I going to get paid for those as well, or do they have to transfer with the business? I know it may be obvious to most of you, but I know for a fact that it's not obvious to everyone. The things that generate value for the business, that's what derive your income and therefore derive the value of the business. And they absolutely transfer with the business and are not paid out separately from the business valuation. And the exception to that would be, let's say you run a pet store and you drive a Mercedes. Well, the Mercedes is not required at all for business operations unless you got something really weird going on. It has nothing to do with the amount of revenue your pet store collects. That would be different. The Mercedes, we cut that out as something that does not transfer with the business. Simple so far, but we're going to take it up a notch, and this is where it gets complicated for some business owners to understand. Let's say, for example, you run a luxurious day spa, and you created that from the ground up. And let's further say you invested $1 million in the build-out. This place is gorgeous. You walk into it and you swear you stepped into heaven, and it was money well spent, and everybody agrees. Now it comes time to sell, and based on our financial review of your business, let's say we said that your business, the market value of your business was $300,000. Very often we receive an objection that says, how could that be? The business has to be worth at least $1 million because that's what I invested into it, and that's what it would cost somebody else to start their own. I agree, and I told you this was going to get weird, and here's the weird part. You're wrong. You're wrong. When selling an existing business, we don't get credit for the money that we invested into it. It has nothing to do. It has nothing to do with the value of the business. It may have something to do with the value at which you're willing to sell the business for, and that's your own prerogative. But in terms of the market value of the business, the amount of money that was invested into the build-out, equipment, machines, has nothing to do with the value of the business. Because all of those things were bought for one purpose, and that was to generate revenue. And taking into account that amount after the business has been operating and now generating revenue is like betting on a game after the game is over. We know what the results are. You may have invested $1 million, but now I'm looking at the results. Maybe the results weren't what you expected, or they're not what a potential buyer would have expected. So again, nothing can force you to sell for less than your initial investment or what you think you want to reap out of the business sale. But in terms of what goes into the market value of the business, we're looking at how does the business currently operate. And everything that you invested to make that business operate the way it's operating today is simply a vehicle to create that revenue. And therefore, in a business valuation, there's no add-on, there's no plus, and there's no extra credit for the amount that you originally invested in. Every business is a little bit different. there are times when this principle that I'm talking about makes it clear that you as the seller would be better off by liquidating what you have if you can, if there's a market for it. My spa example, probably a bad one. But if you are in a construction industry where you bought a lot of equipment and heavy machinery, well, that's something that we would look at. And that's called liquidation value. Forget goodwill and forget the business as an ongoing concern. What do the pieces and components add up to? And if that is more than the business would sell in its entirety, which is possible, that happens sometimes, then that might be your best option. My name is Matt DiGeronimo with Floyd Mergers and Acquisitions. Thanks for joining us. We'll catch you soon.